The US housing market has reached its peak. If you own a home, the next 18 months will decide what your biggest asset is worth. And if you've been trying to buy one, you already know the pain because affordability just hit its worst levels in a generation. The typical American home just hit a record price of $440,000 in June. That's according to the National Association of Realtors. In the exact same month, buyers vanished. Pending home sales, which are the signed contracts that turn into completed sales a few weeks later, plunged 5.4% in June, the steepest monthly drop in 4 months. So we have record prices sitting on top of collapsing demand. The last time those two things happened together was 2006, right before the biggest housing crash in modern history. The rest of the data is telling a similar story. Mortgage rates hit a one-year high of 6.6%. Affordability has fallen for 5 months in a row, and mortgage applications keep dropping. Today I'm going to walk you through 4 things: why the average American family can't afford the average home, the brand new law that just kicked the biggest landlords in the country out of the market, why are American home builders worried, and how every piece of this lines up almost perfectly with the 18-year real estate cycle that points straight into 2026. So let's get straight into the data. The affordability trap has been crushing American home buyers. Existing home sales, which are people selling the houses they already live in, was just 4.09 million per year in June. A healthy market normally sells 5 to 5.5 million homes a year. So America is selling homes at a pace roughly a fifth below normal. Buyers can't buy and owners can't sell either. Back in 2020 and 2021, mortgage rates fell to the lowest levels in history, and millions of Americans locked in home loans at around 3% for 30 years. Today, a new mortgage costs 6.5%. So if you sell your house, you lose your cheap loan and your next home comes with a rate that's more than double, adding hundreds of dollars a month for a similar house. Most families are just staying put. All of this comes down to affordability crisis. Back in 2020, the monthly payment on a typical American home was around $1,500. Today, that same home costs over $2,900 a month due to inflation and higher mortgage rates. To qualify for a mortgage on the typical single-family home, a household now needs an income of $109,000. Meanwhile, the typical American family only earns around $83,000. The average family can no longer afford the average house. And the families who do manage to buy are handing over close to 40% of their income just to cover the mortgage. That's according to Redfin data. When you look closely into the data, you can spot a clear trend. For buyers under 40, house prices compared to incomes have climbed back to levels we last saw just before the 2008 financial crisis. So sadly, interest rate cuts aren't coming to the rescue. Fannie Mae, one of the biggest names in American mortgages, is forecasting the 30-year mortgage rate to average around 6.3% through 2026 and 2027. That means the big rate cut everyone is waiting for, the one that makes the mortgage payments cheaper, isn't coming anytime soon. The pressure is also showing up in ordinary households. American household debt just hit a record $18.8 trillion, while consumer sentiment sits near the lowest levels ever recorded. Which brings us to the second crack. If regular buyers can't buy, who has been holding this market up? For years, the answer is big institutional landlords. These are giant investment funds that buy up thousands of family homes at a time and rent them back out. This month, Washington changed the rules. A new law called the 21st Century Road to Housing Act was just signed. Any for-profit company that owns 350 or more single-family homes is now banned from buying any more existing ones, which means the biggest landlords in America are unable to bail out the market. However, there is a loophole, as there always is, right? The law only blocks them from buying existing homes, so the giants can keep growing by building brand new rental homes instead. Nationally, these institutions only own around 3 to 4% of single-family rentals, so the headline impact is smaller than people think. But they're flipped from buyers to sellers. The number of homes listed for sale by big institutional investors has more than doubled this year, from 4,100 in February to 9,400 by July. That's 54% of those listings have already taken the price cuts. The smart money in housing is heading for the exit. In some cities, this matters enormously. In Atlanta, for example, institutions own over 25% of the single-family rental homes, which is around 72,000 houses. Memphis, Charlotte, Jacksonville, and Tampa are heavily concentrated too. So when the biggest buyers in a city become the biggest sellers, you'll expect house prices to drop drastically. The law comes with a 180-day countback before it fully kicks in, which means full effect should be felt in 2027. Home builders are also important in this equation. Every month, America's home builders get surveyed on how confident they feel, and the result is called the Builders Sentiment Index. A score above 50 means most builders are optimistic, and below 50 means most of them are worried. That index just fell to 34. It has now been below 50 for over 2 years. That's the longest stretch of builder pessimism since 2012, when America was still crawling out of the last housing crash, right around the low of the last cycle, mind you. And they're acting on their pessimism. 37% of US home builders cut prices in July, up from 35% in June and 32% in May. 63% are throwing incentives at buyers just to get houses sold. Now, that's never a good sign when you get some sort of extra guarantee. While new home construction has fallen 3 months in a row, some builders are even shrinking the houses themselves and trimming the square footage just to keep the price tag within reach. The entire industry is bracing for a housing market crash. At this point, I've been pretty doom and gloom, so now I'm going to be realistic with you. Housing doesn't crash overnight. It often rolls over region by region, and that's exactly what the state data is showing right now. And in some cases, you may find cycles where the bottom has already formed, and that would be the place you'd want to go to be buying on the way up as an investor. But now let's take a look at a few of the other states. Texas home prices have now softened for 11 months in a row, with Austin down about 3.3%, San Antonio down 1.9%, and Houston down 1.7%. Sellers across the state are cutting around 25 grand off their asking prices. We're also seeing that in Australia, if you're interested. Florida's Gulf Coast is leading the declines. Cape Coral is now the fastest falling market in America, down 9% in a year, according to ATTOM, while Tampa is down 1.4%. Denver is softening too, and Atlanta has seen pending sales weaken sharply this year. Meanwhile, the coasts are telling a completely different story. The Northeast was the only region where sales rose in June, with the median price up 3.9% in a year to $564,800. And New York home prices just hit a record $475,000. It's also the only region in America where house prices are rising faster than wages, because states like New York, New Jersey, and Massachusetts still have 25 to 40% fewer homes for sale than they did before the pandemic. Low supply means no price drop, at least not for now. This is why the national average looks fine when you group the data together. But pull the data apart, and it's showing early warning signs. Nationally, there are now nearly 50% more home sellers than buyers in the market, according to the National Association of Realtors. 39 of America's 129 largest housing markets are already posting yearly price declines, and 17 states now have more homes for sale than they did before the pandemic. This is an early sign of the supply side cracking as the sellers compete with each other. That competition is how price declines spread. Housing downturns always start with the hottest markets running out of steam first, one at a time, long before the national number shows it. By the time the national headline confirms the turn, it's already happened months ago. When you zoom out, none of this makes full sense as random isolated events. The affordability trap, the landlords selling, the builders retreating, specific areas cooling only click into place when you see the pattern underneath. The pattern is the 18-year US real estate and economic cycle. Real estate moves in rhythms of roughly 18 years. The pattern is 14 years of prices going up, then about 4 or so years going down. In the last cycle, American home prices fell around 27% from their 2006 peak into the bottom around 2010 to 2012. The worst hit markets like Las Vegas and Phoenix lost more than half their value, and it took the average American home nearly a decade just to get back to its old price. That's what the downside of the cycle has looked like before, and it's why the timing of your next move matters so much. Fred Harrison mapped this whole strategy out in the UK, and Phil Anderson refined it using the US land data going back more than 200 years. That framework allowed Harrison to call the 2008 housing crash more than a decade in advance. If we try to do the same, the last major housing bottom in the US was around 2011-2012. So we count 14 years up from there and you land right around 2026. The final stretch of the boom is known as the winner's curse phase. It's a phase where the last buyers pay the highest prices with the thinnest deposits at the worst possible moment in the cycle. So based on that data, we're likely at this stage now. The successful people who study the cycle have had this year in their windows circled for a very long time. Every sign is pointing at the same conclusion. Record prices are paired with the weakest sales and the worst affordability in a generation, which mirrors the 2006 setup almost exactly. The biggest institutional landlords have flipped from buyers to sellers, dumping homes, cutting prices, right as the new laws lock them out in early 2027. And building confidence is stuck in its longest slump since the last crash, with a third of them slashing prices to survive. And we've seen that trend happen for quite some time now. That is what the peak of the 18-year cycle looks like just before the roughly 4 years down begins. Every cycle peak of the past told us this time is different. The narratives always follow the price. In 2000, it was the new economy. In 2007, it was the Great Moderation. In 2026, it's something like the AI productivity miracle, but the outcome is always the same. Deloitte and EY both have US growth slipping towards 1.8 to 1.9% next year. Now, I want to be clear because I'm not here to sell you doom. Market tops are a slow process, and I'm not telling you the US housing is ready to collapse next week. This might grind out over years, and I could be wrong, but there are also areas of the housing market that may be bottoming. Millions of homeowners are sitting on cheap 3% mortgages they refuse to just give up, which keeps homes off the market and can hold prices up a little longer than anyone expects. Lawrence Yun, the chief economist at the National Association of Realtors, has warned that if this number of homes for sale stays this low, prices could push back up or remain on hold. And we have to remember the difference between nominal prices and real prices, which factor in for inflation. But I'd rather be prepared and a little bit early here than caught out completely. So if you own your own home and your payments are comfortable, don't panic sell. But don't bank on a rescue rate cut arriving to bail you out either, because the forecasts say rates stay around 6.5% through to next year. If you bought in the last couple of years near the top, this is the moment to build a 6-month cash buffer and stress test your budget. If you're a buyer sitting on cash, patience is key. Don't rush to catch a falling knife at the peak of a cycle, because buying at the wrong moment can cost you years just to get back to break even, let alone all the costs that you've incurred over that period. Make sure you're all watching your local market, the listings, the days on market, and the price cuts, because we're on the cusp of a generational opportunity. It does take time, you need to have some patience. The signals I recommend you watch are pending sales, builder sentiment, and which regions break first. But if you're looking more specifically in your region, then definitely keep a lookout for the home price sales and how those have been tracking over the last 5 to 7 years. If they have been down and very poor sentiment overall, that could be a fantastic place to start looking. Those numbers will tell you whether you're right, early, or wrong. If this video helped you see the setup more clearly, hit the like button, subscribe to the channel. I cover charts, stocks, commodities, and Bitcoin over on my other channel, Jason Pizzino. There's also a link to that in the description. Otherwise, I'll see you guys at the next video. And until then, take care and peace out.